Stocks and markets. Just when you think you understand them, they do everything possible to remind you just how silly you are and that you are wrong. Well,
Right.
John Iannucci, Wall Street has been on a roll lately. Why?
Well, Patrice, to your point, U.S. stock markets closed at record highs recently. The S&P soared past 5,200 and the Dow broke through 39,500. And all of this occurred after the Federal Reserve announced that it was keeping interest rates unchanged. And so, the Federal Reserve seemed to signal that there might be 3 rate cuts this year, but they've been talking about rate cuts for nearly a year with no actual rate cuts.
All right, so they haven't cut rates. Why
Mhm.
would the market see that as a positive? Why would they soar?
That's a really great question. And candidly, I think that's a question that every investor should be asking. It's really difficult to describe the current market environment. The S&P has more than doubled since the pullback that was created by COVID pandemic. And recognize that record-breaking growth actually took place in spite of, right? 2 major wars abroad, an alarming banking crisis with failures, bank failures,
Mhm.
lending rates, climbing to 23-year highs, a corresponding slump in the housing market, and widespread predictions of a recession.
Well, those predictions didn't exactly come about. I mean, they didn't happen.
No.
So, but markets looked at all this and said, "Yeah, so what?"
Mhm. Right. That's exactly my point. And yet, what I'm concerned about through my clients and folks that I talk about is that investors seem almost driven right now to jump on the bandwagon. If they're not making double-digit returns, they're wondering if they have the right advisor. But even Federal Reserve Chairman Jerome Powell refused to sound a warning over the latest higher than forecast inflation readings.
Yeah, you said jump on the bandwagon. That's
Mhm.
not a good thing, though. I mean, aren't you a little behind? And
So that's exactly the issue. When investors talk about jumping on the bandwagon, I know they've heard from friends and colleagues that they're earning double-digit returns. But what we know is that this market is actually driven by what we call the Magnificent Seven. And that Magnificent Seven consists of Tesla, Nvidia, Amazon, Alphabet, Microsoft, Meta Platforms, and Apple. And they make up a very significant percentage of the S&P 500 market value. And most of that is being driven right now by advances in artificial intelligence. Those companies have actually grown an average of 19% so far this year.
mm,
I have clients that read an article about NVIDIA's growth over the last 18 months, calling me to see if they can invest heavily in that stock now after all of that growth has actually happened. And it's beginning to feel like investors are doing exactly what Warren Buffett talked about. They're getting greedy right now.
and if they are getting greedy, what
Mhm.
should the listeners be doing?
Well, it's like Warren Buffett said, be fearful when others are greedy and be greedy when others are fearful. So now that we're seeing this kind of notion of investors becoming greedy, I think it's time to start becoming fearful.
Hmm.
You know, Michael Hartnett, the chief investment strategist for Bank of America, recently told Bloomberg that it sort of feels like momentum is moving toward a bubble. Bubble's always a bad word because bubbles always burst. Chris Senyak, the chief investment strategist for Wolf Research, has called the biggest risk in the market the potential formation of another late 90s style bubble.
We've seen those bubbles. We know when they
We've
pop.
experienced those, right?
Yeah, yeah. You want to be fearful. That's
Right.
something to be fearful about. So,
Right.
if you're recommending, if you are recommending that our listeners become
Mm-hmm.
fearful, are you
Mm-hmm.
saying more conservative? What steps should they be taking?
So that's a question with a lot of moving parts. I can't provide kind of a blanket advice that applies to everyone that's listening to us today. There are a lot of personal factors that have to be considered and integrated into the creation of a comprehensive plan moving forward. For instance, if any of our listeners are anticipating retirement in the next 5 years, or more importantly, have already retired and are drawing on those investments to support the retirement, the importance of sequence of returns is critical. A major pullback in the market during that very critical period could lead to catastrophic results in the retirement.
Ah, yes, sequence of returns.
Right.
Always pops up, doesn't it?
Mm-hmm.
We have reviewed this in the past and the importance of the sequence of returns,
Right.
especially just before and after retiring.
Mm-hmm.
But retirees, when they see the market surging, don't they tend to they follow the crowd? They chase that bandwagon. They want to ramp up their risk.
Exactly. Sure, they do. And that's kind of emotional investing. That's the worst type of investing, emotional investing, right? Buying after the surge has happened, selling after the trough has happened. And so, yeah, they're always tempted to significantly grow their retirement accounts when they see the market surging. But here's the problem. Those very same investors are hoping to wring that last bit of growth out of the market and get out of those risky investments just before the market crashes. And you've probably heard of this phrase before. We've commonly referred to that as market timing. And candidly, that's a strategy that rarely, if ever, works.
And it takes a toll on your nerves and your stomach,
Oh my God. Yeah.
Yeah. So
Those are when I get those calls from investors, right? Should I buy? Should I buy more? Should I sell? When should I sell? Right.
yeah.
Mm-hmm.
Well, John, what steps can we recommend to listeners to help them determine just
Mm-hmm.
how they should proceed in the future?
Well, let's begin with Warren Buffett's recommendation. It's beginning to feel like investors are getting greedy, so it may be time to become fearful. How do they accomplish that, right? Here's our recommendation. First, make sure that they take an updated risk questionnaire to determine both their risk score and their risk tolerance. Update that information with things that have happened in your life since you took that last risk questionnaire. Doing so helps an investor realize how much downside risk they're willing to assume. The best of those questionnaires really talk to you about, if you want double digit returns, are you willing to risk double digit losses?
Mhm.
Right.
Yeah.
And so, second, you have to have a competent professional run a stress test against their current investment portfolios, like we've talked about in the past, right? That stress test will give them a report that will quantify what a market shift might actually do to their current investments. And that's all based upon historical returns during different market scenarios. You want to know that if the market makes a shift in a particular manner, how have your investments, your holdings, reacted to those kinds of shift in the market in the past? That's the best we can do. We don't have a crystal ball. All we can do is look at how those companies and the valuation of those companies responded in similar market situations, right? Third, you have to request and thoroughly evaluate alternate investment strategies that certainly provide and allow for some level of continued growth within your portfolio. You don't want to put your portfolio in cash, because you're losing ground, you're losing track just to inflation alone at that point, right? So it's smart to add some layer of downside protection from major pullbacks, but also that allows the growth within your portfolio to outgrow the cost of inflation, right?
Mm-hmm.
Otherwise, we'd all have cash under our mattresses. And then finally, and this is really important when it comes to emotional mindset and trying to eliminate emotion from investment decisions. Don't fall into that trap of comparing your investment results with the investment results your friends claim to have. You haven't seen their statements. It's what they claim to have, right? That type of greed-based thinking can lead to disastrous results should the market momentum shift suddenly, right? I often hear people sitting around the table at lunch after playing around the golf or pickleball bragging about their recent investment returns. Have you seen, oh my God, my portfolio doubled? I have one of those clients that can't stop bragging about how much money
Really?
they made on a particular investment, right? And even though you have no idea what your friend's investment returns really are, or the specifics of their financial needs. Maybe they're in their life right now in a position where they don't have to worry about risk quite so much with respect to their investments. They may have a pension plan that handles all of their basic needs, right? So there's a temptation to call your broker and advisor and start demanding answers about why you're not achieving those same results. All I can tell you is please don't do it. Don't get emotionally involved in that investment decision. So when the market begins to feel like a runaway freight train, that keeps surging forward in spite of contrary market and global conditions, maybe it's time to do what we've talked about before, like great poker players do. Start taking some of those chips off the table. And don't let the potential tax consequences of liquidating certain investments be your deciding factor. Tax rates, we know for certain, are not going to be this low again in the foreseeable future. I just read two great articles this morning that said now there is bipartisan support on both sides of the House, support to begin taxing at higher rates successful families, right? So please, these are the lowest tax rates are going to be for the foreseeable future. Do not let the tax tail wag the dog and make that deciding factor be, oh, how much tax am I going to have to pay if I sell this stock that has gone up so much in the last 18 months? When it seems like investors are becoming greedy, maybe Mr. Buffett's correct. Start being fearful.
All right, listeners, John does have an offer for you, and we're going to talk about that in just a minute. But first, John, you mentioned Congress. This is a presidential election year.
It is.
How do you believe stocks, or is it your opinion that stocks care about politics, or do they just care about business?
Good point. So what we've learned when you go back and you look at studies that reach back 40, 50, 60 years, what we learned is the stock market doesn't care about politics as much as we would think, right? Leading up to an election, there's often a lot of volatility. It has nothing to do with the actual politics of the various parties. Typically, that volatility is because there's no settled idea of how our country is going to go forward, right? Whether it's going to be a Democrat, a Republican, an independent, whether there are feelings about increased taxes and so on. So that uncertainty causes volatility in the market. That uncertainty causes the market to get very jittery. Candidly, I think the market shows more interest in what's happening on a global basis than it does, more concern on, for instance, the two wars that have happened recently. They're more concerned about, the market is more concerned about those activities, that global market, than actual national politics. Consistently, after the election, once there's been some settlement of knowing how we're going to go forward and what that party's intending to attempt to accomplish, how Congress is divided between the various parties, the market seems to consistently react positively and take off again. So I think that in answer to your question, the market doesn't really care about politics as much as we think it does.
That's fascinating.
Mm-hmm.
All right, so John, you did outline 4 critical steps listeners should take to evaluate, look at their situation, and understand it.
Right.
Where can listeners go to accomplish those 4 steps?
Well, it's no surprise by now that we have a special no obligation offer to our listeners. So any listener that's interested can simply reach out to me at wecanhelpyou.com and request our free risk score questionnaire and a free portfolio analysis. We'll provide them with an update on the risk score of their portfolio, and a stress test of their portfolio so they understand how much risk they're currently assuming and how much risk it makes sense to assume going forward. We'll provide all of those test results and information necessary to help them decide if it's the right time to heed Mr. Buffett's sage advice.
All right. Again, that is wecanhelpyou.com.
Yes, ma'am.
All right, listeners, subscribe to this podcast to make sure you know when the next episode is ready for you And of course, share it with others, please. I'm Patrice Sikora, and thanks for being with us.
Thanks so much, Patrice.
Thank you.